Okay, in this series of videos, we're going to look at leverage and alternative forms of financing for real estate investment. Real estate is much like any other business, and investors in real estate will use a mix of debt and equity to fund the purchase of this real estate asset. And down here we have a picture of a capital stack, a very simple capital stack for a real estate purchase, where we have debt and equity, a mix of those two, and the priority actually starts from the ground up. So the debt in this case has first priority over cash flows. They will get paid back before any equity can be returned. Typically that's what banks will require, and so the equity is up at the top and they get the residual cash flows from the project once the debt is paid off. As with other businesses, the use of debt in real estate increases the risk, but it also magnifies the returns associated with real estate investing. The use of debt increases the risk or the variability of cash flows associated with real estate investment. And if we have a situation where the cost of debt is less than the return earned on the asset, that is the ROA, then we have a situation that's termed positive leverage, and our return to equity is going to be increased and magnified. On the other hand, if an owner pays an interest rate that is higher than the return on the property, then the returns will be pushed lower and we'll have a situation of negative leverage. And over the next couple of slides, we'll take a look at both the increase in the variability of cash flows and the risk associated with debt, but also we'll take a look at how debt magnifies returns. So first let's look at the increased variability or increased risk associated with the use of leverage. And we'll do that by considering an example here. We're going to look at a real estate asset that costs $1 million, and initially we'll assume that there's no loan. We're going to have cash flows over the next 5 years that are uncertain. So that's an example of the business risk associated with real estate investment. And we're going to look at three different possibilities or three different scenarios for this real estate asset. The first scenario is the pessimistic scenario, where the year one net operating income turns out to be $100,000, and then that NOI decreases by 2% per year over the life of our holding period. At the end of the 5 years, we're going to sell the building for $900,000. The second scenario here is the most likely scenario, and this is one where the year one net operating income turns out to be $110,000, and that's going to remain flat for the next 5 years for the life of our hold on this asset. We're going to assume that the building is sold for $1.1 million at the end of those 5 years. And then finally we have the optimistic scenario, where year one NOI is $120,000, and that is going to grow by 5% per year over the 5-year holding period. At the end of the 5 years, we're going to sell the building for $1.3 million. And let's just take a look at the spreadsheet. We're going to see that the expected return given all of these scenarios is 13.2%, and we're going to have a relatively small standard deviation of 3.3%. So let's go look at Excel and see what this looks like. So again, over here on the left you have a description of the scenarios, and we're looking at the cash flows for these buildings. Those were outlined in the previous slide. We have the probabilities of these different scenarios over here. So 20% chance that we're going to be in the pessimistic world, 50% chance in the most likely scenario, and then 30% chance that we'll be in the optimistic scenario. If you look at the returns for each of these three scenarios, the worst one, the pessimistic case, gives us a return of about 7.9% for the IRR. The most likely scenario gives us 12.5%, and then the optimistic scenario, we're a little bit over 17%. Down here at the bottom, I've taken kind of a weighted average of the cash flows, the expected cash flows, and you can see our expected return would be 13.2%. Over here on the right, I'm not going to walk through every step of the calculation of the standard deviation, but you can see that we come up with this measure of the variability of the cash flows. The standard deviation gives us a sense of how widely dispersed those cash flows are. So 3.29% is the standard deviation, assuming we have no loan built into our property. So this is just a picture of the risk associated with the uncertainties of running this real estate business. So let's go back to the slideshow and consider what's going to happen with adding debt to this particular asset. So let's look at the assumptions we're going to be using. We're going to continue with this same real estate asset, but we're going to layer on a loan now of $700,000 at a 7% interest rate. We're going to have loan payments based on annual payments and a 20-year amortization period. So the cash flows from the property remain uncertain, but now we're tacking on a fixed payment of about $66,000 for the principal and interest that's due. And we'll see here that there's positive leverage. We're going to talk about that more later, but there is a bigger spread in the possible outcomes, a higher standard deviation, and therefore more uncertainty and more risk. So we'll see that the expected return is about 25%, but the standard deviation has jumped up to 13.6%. Let's just take a look at Excel for that. So down here in the bottom portion, over here I have the assumptions, the loan to value, the interest rate, and the term. I have the calculations showing up in these cells here. So there's the payment calculation. There's what the loan payoff would be after 5 years. So that's all factored into the cash flows down here. These would be the leveraged cash flows for this property. And over here to the right, we have the levered IRR. So in the pessimistic case, we've got a 10. In the most likely scenario, we have a 23. And in the optimistic world, we would have an IRR above 34. Again, there's the calculation for the standard deviation, and you can see it's jumped up quite a bit from the 3.29% for the unlevered property. Now it's at 13.6% with the leverage added. Over here on the right, I've put together a data table, and I think I'm going to go ahead and walk you through the construction of that real quick. It just shows how the standard deviation or the risk increases with our increased use of leverage. LTV is a measure of leverage, and we'll talk about that a little more later. So as that goes up, you can see the standard deviation or the risk is going up as well. And then over here I've just graphed that relationship, and you can see it's not a linear relationship. So you can see with the loan to value is on the bottom axis here, and the standard deviation is on the vertical axis. And so you can see as we increase the use of debt, our risk goes up very quickly indeed. So I do want to show you how to construct this data table. I want you guys to be able to do these sensitivity analyses. So we're going to start with this particular one, and I'll show you how I constructed it. So first, I've created a column that shows the different inputs that I want to consider for the loan. So 0% loan to value is going to obviously mean no loan, and then we're going to just move this up in increments. In this case, I chose 10% increments until this very last one where we have a 95% loan to value. So these are the different iterations, the different considerations I have for the loan amount. So what I want to see is the effect of this loan amount on the risk, and in particular on the measure of standard deviation. So to create this data table, I'm going to link in this little cell, and I'm going to go ahead and term this the special cell. It's going to be right below our column here for standard deviation. I'm going to link to our measure or our calculation of standard deviation in the spreadsheet. So I've linked to the cell N26, and I've kind of made that small because it's really for reference only. It's not part of the data table per se. So once I've got this column of possible inputs, I'm going to highlight this entire area, and I will move up here to data. I'm going to click on the data tab, move over to what if analysis, and then click on data table. And you can see I've got this really simple dialog box, two possible inputs. There's the row input cell and there's the column input cell. And I want you to notice that for this particular spreadsheet, for this particular sensitivity analysis, all of my possible inputs are aligned in a column here. So I'm going to use the column input cell. And those column inputs, all of those possible inputs are loan to values. So those are possible numbers that I could enter as the loan to value. So what I'm going to click on now is the loan to value cell, that input cell way over here on the left. And so what Excel is going to do is it's going to in turn put in each of these numbers into that loan to value input and see what the resulting output is, the resulting standard deviation or the resulting risk measure that we're concerned about. So I'm going to go ahead and hit enter here, and it populates those numbers. I've already pre-formatted them as percentages, and then again I have this graph down here. So we'll work on these data tables, these sensitivity analyses more, but I want to show you this one, and I'd encourage you to take a crack at practicing it. Students have notoriously had a difficult time creating these, so follow with the video. You have the spreadsheet at home. I'd encourage you to take a crack at creating this data table and thinking how you did that and thinking what it means. So I'm going to go ahead and stop the video here, and we'll pick up with the slideshow on the next slide and take a look at the apartment building and building the pro forma there. So I'll see you next time.